Now, the long version is very simple. It actually started quite a while before. I didn't do it in the beginning, but sometime I believe in like March of '99, I got the brilliant idea to short like 10 internet stocks, which were up like 7 or 8-fold at Soros. And I think I put 200 million into the quantum fund short. And within about 4 weeks, the 200 million investment was a $600 million loss. I didn't just misstate that. I lost 4 times. Well, 3 times my investment. So, because the 200 million went to 800 million, then I covered it. So I was very bruised. I was down mid-teens. I'd never been down double digits before, and I was exhausted. And then I kind of backed off, and for a few months I realized Greenspan was doing this huge easing program because of the Asian financial crisis, but there was no crisis in the United States, but we were pumping all this money in. And I could see the tech revolution, and I said, oh my God, I've got to go along. So one of the things I did was hire two people in their 20s who were sort of gunslingers, because I knew, gets back to Bitcoin now, I knew the younger people knew the new companies like Veritas and VeriSign and that kind of stuff. I didn't know how to spell them. So I'm down like 16% or something. We pivot into this stuff in the summer. And by the end of the year, we're up 42% net. We have this massive year. I go into George in January and I said, this is crazy. We're in a bubble. I'm selling all the technology stocks. So I sell them. This is January. And then the 2 gunslingers are still there. They have little small accounts, so I can size them up when they're hot or cold per our earlier conversation. And then, as you just said, they're making like 8% a day. And it's driving me out of my mind because I'm out of the market. So we're now getting into March, and there's the little devil here going, March of 2000. The little devil here is going, do it, do it. And the little devil here is saying, don't do it, don't do it. And I think I missed the top by an hour, and you said I bought a few things. I didn't buy a few things. I put like, I think 6 billion. And which turned into a massive loss, 2 or 3 billion. I knew like 5 days after I did it, but the whole exit, it was messy. So now I'm down like 18% again. And I had just been down 18% the year before, and I'm literally like an emotional mess. And to your point, I know I'm an emotional mess. So I go into Soros and I say, I'm quitting. I need a break. I'm exhausted. I write a letter to the Kane investors. I had 2 firms going, and I said I'm going on sabbatical. I might come back. I might not. Right now I'm a mess. If you want your money, here's the number. Just call. We'll send you all your money back. I did cheat a little. I said if you take your money out, I might not let you back in, but you're free to take it all out. Okay. So I go to Africa with my kids. I don't allow myself to see a TV or to read a financial newspaper, so I don't know where anything is. So it's a true break, which is something I'd advise young traders to do. If you take a break, take a break. Don't sit there and like trade your own account and mess around. So I come back on Labor Day because my kids are going back to school, and I'm sure my wife doesn't want me around the house. So I open up a newspaper and I can't believe it. The NASDAQ has recovered like 70 or 80% of their losses. The S&P is almost back to the high, but oil is up, interest rates are up, and the dollar is up. By the way, that might sound a little familiar. And this has always been terrible for corporate earnings looking forward. So I mentioned this to my good friend Ed Hyman. I go, what's going on? And I said, oil is up, interest rates are up, and the dollar's up. Why is the market up? In the meantime, I'm calling all my ex-clients who are small businessmen. I didn't have big fancy clients, and they're all telling their business is terrible. Okay, so Ed sends back a regression thing 2 days later showing that if you have oil, interest rates, he plugged in the percentages, and the dollar up this amount, earnings the next year forward based on history go down 35%. And the average earnings estimate of the Wall Street guys is up 18. So I then get the idea, and I'm down. And one of my trading rules is you don't trade a lot when you're down. But I've had a break. My mind is fresh. I just love this idea. So I put 350% 10-year equivalent of the fund into treasuries, betting that Greenspan, who has a tightening directive, will reverse and we'll go into a recession. And to make a long story short, I make 40% in the fourth quarter, even though I had given up on the year and decided I was finally going to have a down year. That's the end of the story. If a company reported lousy earnings, opened down that day and closed up big, that stock market was going to be higher 6 months from then, and vice versa. You could almost always guarantee if the economy looked great and bonds were rallying, that meant the economy was not going to look so great. We used to call it price action versus news. And it used to be an incredible indicator of security prices, partly because of the efficiency, partly because I think the growth of hedge funds, we all learned these rules, and partly because of central bank manipulation. Price versus news is a very weakened tool versus 20 years ago, much to my chagrin, because I always found it a great warning signal, and now a lot of times it may be warning of nothing or warning of something that doesn't exist. So that's been one thing I've had to adopt to. I mean, frankly, when I started in the business, I'm showing my age here, which was the mid 70s, I started in equities. I also learned, particularly in bear markets, that I had to morph into bonds, into commodities, into foreign currencies, things like that. I mean, one of the most challenging things for me right now is, maybe it says something about my dysfunctional personality, but I've always made even higher returns in bear markets than bull markets. But the way I did it was just pretty much ignore equities, take them off the table, buy bonds, buy treasuries, and go home. Well, I've never been presented a cocktail where you have 8% inflation, you think the economy might weaken, and bond yields 3%. It's an analog with no precedent in history. So for the golfers out there, going into the situation we're describing, I feel like I'm about to play a round of golf without a driver and without a 60-degree wedge, because bonds, which have been my go-to asset in terms of a recessionary bear market atmosphere, they may work, but there's good reason to believe things may be different this time, because we've never had central banks with situation in Europe, for example, we have negative rates with 8% inflation, or even here, we've never had anything like this. So you can't get into black and white, that it's an art form investing in from cycle to cycle. You have to constantly innovate and not just be a slave to past models.
So how are you positioning the fund given that, maybe you don't feel so good about going long equities, but your normal bond toolkit is not working quite well? Is the golf thing top of mind because, it's actually hard to do too much? Or how are you positioning things?
Well, currently I'm very challenged. We were lucky enough to have made some money up until now, the last 6 or 8 months, primarily by having let me call it a matrix of short fixed income, short stocks, and not doing a whole lot in currencies, and owning some of the key commodities, particularly oil and mistakenly gold, but copper. Things are a lot harder now because we're now getting definitive signals that the economy may be weakening, particularly at the front end. And while I'm not comfortable owning bonds, I'm much less comfortable being short fixed income to the degree I was 3 to 6 months ago, when it looked like a much better risk reward. And even stocks, so many companies have been derated by 60 or 70%, And I've lived through enough bear markets that if you get aggressive in a bear market on the short side, you can get your head ripped off in rallies. So currently I'm coming in every day and I'm looking at my screen, but I'm pretty much taking a break. I'm waiting for a fat pitch. I'm not shooting at any pins, to use a golfing analogy. My anticipation is I will be going back to the short equity position at some point if the market affords me. If not, hopefully I'll just sidestep a decline. That's not the worst thing in the world. But the fixed income market has become much more complicated. And I'm lucky enough, since I play in a lot of asset classes, to have the luxury of not playing in one. And I don't think I'm going to be playing much in that one going forward. The currency market is incredibly interesting to me. I haven't been doing much there, and I'm not currently positioned aggressively there. But I will be surprised if sometime in the next 6 months I'm not short the dollar. $14 trillion has come in here because we were the first to tighten. There's a story about American exceptionalism. I'm not sure we're so exceptional anymore, and if we are, I'm not sure I'm excited about what we're exceptional in. So foreign exchange looks interesting. We still own energy and other commodities. Ukraine sort of gave that trade an extended life, although I must say the energy, because of the transition to ESG, we look to be short energy for 5 or 10 years, so that could last a while.
It's so interesting to hear you talk about this stuff because you so fluidly move between all these different asset classes. And one thing that makes me think of is crypto. Obviously, you've done kind of a little bit in crypto before. I remember you saying that it's just hard to get the size of position that is interesting to you in crypto. One thing I was wondering, are you seeing crypto start to affect other asset classes and other currencies?
I don't know whether I'm seeing it, but I expect it to. You can't build over 2 trillion in wealth in purchasing power and then take 1 trillion of it out and not matter. John, I also have high frequency signals, and there certainly seems to be a strong correlation between crypto and the NASDAQ. I don't think it takes a genius to figure out why. So I'm looking at it as an indicator that way. Crypto, everything that Charlie Munger says about it, I'm sympathetic to. Everything that says Bill Miller says about it, I'm sympathetic to. So I think that's a movie that has yet to be played out, and one that I don't want to bet on in conviction, but I will be very surprised if blockchain isn't a real force in our economy, say 5 years from now to 10 years from now, and not a major disruptor with companies that will have been founded between now and then that'll do very well, but that will also challenge things like our financial companies and do a lot of disruption. So I find crypto interesting. My 69th birthday is in a couple of weeks. I'm probably too old to compete intellectually with the young people in this space, but I'm certainly monitoring it.
I was going to ask that. Do you think younger Stan would be kind of diving into crypto more energetically?
I think a younger Stan would be diving into everything more energetically than I'm talking to. Age is a funny thing. I feel my predictive power and forecasting power is as good as it's ever been the last 3 to 5 years. But I'm certainly not making 30% net returns per year like when I had clients. So I think it's two things. Yes, I think younger people understand new asset classes better. But B, I'm just not playing anything as aggressively as I used to.
I want to get back to that because that's interesting. But one other crypto-related question: as I think about Bitcoin, the closest analog is clearly gold, and people talk about digital gold. By which I mean, if you want to remove yourself from cash, if you want to be independent from inflation, your government in whichever country you're in, traditionally gold would be the asset that you would kind of pull back into. Nowadays, that can be Bitcoin. And so you'd expect their cyclicality to be similar. And yes, Bitcoin is highly cyclical, gold is counter cyclical historically. Why is that?
I'm not sure why, other than NASDAQ type risk play takers are the ones that tend to play in Bitcoin, and curmudgeons that are gold bugs and want the world to fall apart play in gold. But there's no question, and this I've watched and it's gone on long enough now that I believe it, that if you believe we're going to have irresponsible monetary policy and inflation going forward, if it's in a bull phase, you want to own Bitcoin. But if it's in a bear phase for other assets, you want to own gold. And I think I just articulated the reason, but sometimes, John, I don't care. This has gone long on enough that I'm starting to believe what I'm observing. And for sure, if I think we're going to have an inflationary bull market, I'd want to own Bitcoin more than gold. And if I thought we're going to have a bear market, stagflation type thing, I'd want to own gold. Doesn't mean I'm going to believe that in a year, but that's my assumption going forward from this point.
And is that because of some fundamentals of the underlying assets, or just based on what you've observed in their behaviors to date?
It's 85% what I've observed, but I would also say it's the type of investor. Over-the-counter FANG type investors, if they believe in inflation and they tend to be younger, they want to play Bitcoin. Old curmudgeons that secretly want the world to fall apart, they don't own Bitcoin, they own gold. So, but that's kind of cheating because